All right, let's dive right in. Today, we are breaking down a really specific investment strategy, all focused on the year 2026. You see, the markets are hitting all-time highs, which has everyone asking the same big question. What on earth comes next? We're going to unpack one expert's prediction and the step-by-step plan that you can actually use. So, let's get to it.
Right now, we are in a market moment that is, well, it's incredibly rare. Just think about it for a second. Gold, all-time high. The stock market, all-time high. Bitcoin, all-time high. Pretty much every major asset class you can think of is peaking at the exact same time. Now get this. This has only happened 2 other times in the last 100 years, and we are living through the third.
So that, of course, raises the billion-dollar question for every single one of us who invests. When everything is at the top of the mountain, where do we possibly go from here? It's that feeling of uncertainty that makes having a clear, well-thought-out strategy more important than ever.
To help us navigate this, we're going to focus on a very specific prediction from investor and educator Ankur Warikoo. His take, that 2026 is going to be a year of a major correction for the stock market. And this one idea, this one prediction, is the bedrock for the entire strategy we are about to break down.
Okay, so why 2026? Is that just a date pulled out of a hat? Not really. There's a whole theory behind this pretty bold prediction, and you kind of need to understand it to see why the strategy is built the way it is.
So the theory behind this 2026 prediction, it's a little unconventional, almost a conspiracy theory. It all starts with a huge global problem. Governments are drowning in debt, and the logic goes something like this. 1. Governments need to borrow money, right? But people aren't saving as much in banks. They've moved their cash into the booming stock market. 2. Governments can't just fire up the printing presses for more money without risking crazy inflation. So the theory suggests that a market correction would be, well, pretty convenient for them. You see, a big downturn would scare investors. They'd sell their stocks and move their money back to the safety of bank savings. And just like that, there's a huge new pool of cash that governments could borrow.
Now I know what you're thinking. Hearing about a potential market crash probably makes you want to just pull all your money out and stuff it under the mattress. But listen, the first and most critical rule for navigating this kind of uncertainty is to do the exact opposite.
And please, if you take away only one thing from this, let it be this. Stopping your investments is the single biggest mistake you can possibly make. Even if you have a hunch that a downturn is coming, history has shown us again and again that trying to time the market is a fool's errand. The real key is to just stay in the game.
And this is where the absolute magic of systematic investing, your SIPs and rupee cost averaging, really shines. When you invest a fixed amount every single month, you automatically turn market ups and downs into an advantage. When the market dips, that same amount of money buys you more units. When it's flying high, it buys fewer. Over the long haul, this smooths out your average cost and is one of the most reliable ways to build wealth.
Okay, so we're staying invested. Great. The logical next question is, what exactly should we be invested in? Now we get to the real meat of the strategy, a super detailed investment framework for 2026, and we're going to break it down based on your monthly income. But wait, before we talk about putting even 1 rupee into the market, there is a step 0. It is non-negotiable, and it's for absolutely everyone. You must have an emergency fund. Figure out what it costs for you to live for 6 months, your essential expenses, and save up that amount in a safe account you can get to easily. This is your financial parachute. Do not skip this.
All right, emergency fund is built and ready to go. Perfect. Let's start with our first income bracket. If you're earning up to 25,000 rupees a month, this strategy is all about playing it safe and building a solid foundation first.
So for this bracket, the main asset allocation is 60% in stocks. But look at this. A really significant 40% of your money is going into safer assets, 25% in debt funds, and another 15% in gold. That's a serious cushion designed to protect you from big market swings. Now let's zoom in on that 60% that's in stocks. The name of the game here is stability. A huge chunk, 70% of it, goes into large cap funds. These are the biggest, most stable companies out there. Only a tiny bit goes to mid caps, and here's the really important part. At this income level, there's zero, absolutely zero allocated to the riskier small cap fund.
Okay, let's level up. Now we're looking at the strategy for an income up to 50,000 rupees per month. With a little more money to invest, the strategy lets us tiptoe a bit more towards assets that have higher potential for growth. You can see the stock allocation bumps up just a little to 65%, and to do that, we bring the debt portion down to 20%. Gold, our trusty hedge, stays right there at 15%. This just reflects a slightly higher comfort level with risk as your income grows.
And inside that equity slice, things get interesting. The large cap holding comes down to 60%, and that extra 10% is used to bring small cap funds into the portfolio for the very first time. So that riskier 20% is now split between both mid and small caps.
And now for the final income bracket in this particular model, earning up to 1 lakh rupees a month. You know, at this level, you have a greater capacity to invest, and that's reflected with the portfolio that's even more focused on equity.
Here we go. The stock allocation hits its highest point for this entire strategy at 70%. Your debt portion is trimmed down further to 15%, which now matches the 15% that's in gold. This setup gives you the most exposure to the stock market's potential for growth.
But here's what I find really fascinating. Even though you're earning more and investing more, the actual risk level inside the stock portion doesn't change from the 50K bracket. The 2026 strategy says, nope, keep it steady. The equity mix stays at 60% large cap and 20% mid/small cap. It's prioritizing stability even when the portfolio gets bigger.
So, we've covered the what, all the percentages and allocations, but that's only half the battle. Let's get even more practical now and talk about the which. What kinds of funds should you actually be looking for to build out this portfolio?
When it comes to your debt funds, it is definitely not a one-size-fits-all situation. For your emergency fund, you want liquid funds, period. You need that money to be accessible fast. But for the debt part of your investment portfolio, short-term debt funds are probably a better fit. They usually offer better returns than a fixed deposit, and they don't have an exit load.
And for your stocks, it is absolutely essential that you understand this risk spectrum. Think of it this way. Large cap funds, they're your solid, stable foundation. Mid caps offer a nice balance of risk and potential growth. And small caps, well, they have the highest potential for huge returns, but also for huge losses. This chart perfectly shows why our 2026 strategy is so heavily weighted toward the safer left side of the spectrum.
At the end of the day, any strategy is only as good as your own discipline. When the market takes a nosedive, and believe me, it will, your patience is going to be tested like never before. That little voice in your head will be screaming, sell, 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 but holding your nerve and persisting through those moments, that is precisely how long-term wealth is actually built.
And that really brings us to the final thought I want to leave you with. While this whole discussion has been laser-focused on a strategy for one specific year, 2026, based on one specific prediction, it really forces us all to ask a much, much bigger question. Are you building an investment plan that's just reacting to 1 year, or are you building a financial foundation that's designed to last you a lifetime?